What's up, guys? This is Mike Sharp. This is Sharp Investing, and it is Applovin earnings day. But before that, I was listening to an interview with Michael Steinhardt, and who's a famous trader, and he said, "All I bring to the party is 28 years of mistakes." So I thought I would explain one of my main mistakes over my, I don't know, let's call it 15 years in the market. I have been in the market longer than that, but I didn't really start taking it seriously until maybe more like 12 years ago. But so 12 years of mistakes. And one of the main one, if I look back and figure out, what's my tuition been for the markets, right? So I'm guessing my tuition has been at least probably $250,000. And a lot of that is from selling too early. And so if you listen to the great investors, they basically say you have to let your winners ride and you have to hold some positions long term so the compounding can work. And so I finally learned that lesson, and I've left Applovin. My purchase price is about $50, and after hours, what is it at now? It looks like it's 500 or 485 now, so it's up over $100 in after hours. And so because I've left a part of my position on, that's over 200% earning or return on my initial purchase price, because the compounding has taken effect. The position has grown, and so even small changes in percentage now are quite a large percentage change in terms of my average purchase price. But usually you have to wait quite a long time for that to happen. I think I got lucky here with Applovin, and it's up over 9 times purchase price. So, and that's in 13 months. So that's pretty crazy. It is a great business though, and I'll go over some of the numbers. 2024 financial review. What am I going to talk about here? So revenue, 4.7 billion. That's up quite a bit over last year. Obviously, I think that's almost 40% up last year. The EBITDA is for the year was 2.7 billion. And net income was almost 1.6 billion. Now the EBITDA is a bit of a silly metric for most companies, and I would say that's true here. I have a bit of an augmented free cash flow number because I don't think that their free cash flow number is correct, because you have to pull out the share buybacks that they use to incentivize the staff, right? Which is a sneaky way of avoiding the cash flow statement. So what we'll do is we'll take the cash flow, which is operating cash flow is 2.1 billion, free cash flow is 2.07 billion, and then we have to remove the share buybacks that are related to the stock-based compensation, which is 370 million. So I would say the augmented free cash flow for the year is about 1.7 billion. Still pretty good. That's quite a lot of cash flow compared to the revenue, right? So they have a very high income margin, and the number is continuing to rise as they grow because there's very little cost to growth for them. They are basically running off their systems that they built, their software that they built, and their AI that is continually the Axon platform that is continually improving the returns for their customers. And when their customers get better returns, the advertisers on their platform, they find more money to invest with the business. So if we look at the quarterly numbers, you'll see the margins here, which are pretty phenomenal. Okay, so revenue this year, last quarter was up to 1.37 billion. That was up more than 100 million from their guidance. They seem to have removed the guidance now. I think that's what they said last quarter. They're not going to do quarter by quarter guidance anymore, which makes sense. They said they're building for years, not for quarters, which is good for us shareholders. They're not just trying to make a quick buck. They're really trying to build a company to last here. So advertising revenue up to $1 billion for the year, and the margins are EBITDA margins. We can use that for this purpose just because you can compare like for like. But the EBITDA margin is 78% this quarter, same as last quarter. So it seems like they've hit their sort of incremental margin rate. And so if we're going to forecast for the future, I think I'm going to use somewhere around there to project future income off the revenue growth. You obviously have to take off the interest because they have a fair amount of debt, and the depreciation is basically non-existent here because they basically don't have any capex, which is pretty crazy for a business like this, a tech business. Okay, so net income, 600 million for the quarter, up huge. That's up 3.5x from last Q4. Now, Q4 should be the big quarter for the year because it's Christmas. There's more advertising on ad networks. So Q1 the growth might slow down a bit, but still they're growing very fast. You can see they added 20% advertising revenue quarter-on-quarter from Q3, and that's up from 17% the previous quarter from Q2 to Q3. So lots going on here. Everything's going right. All the numbers look good. Net income margin, 44% for the quarter. That's up from 18% a year ago. So, and up from 36% last quarter. So this is a cash machine. And you could see if they can actually leverage their tech stack and increase revenue over the next 5 years, you could see the net income potentially becoming multiples of what it is now. But that means it's required on them to find new ways, new paths to new advertising and leverage their customer base even more. And I mean they're doing that, so I don't have any reason to doubt them. Although at some point they're going to clash with the big boys, and we'll see how they do then. Maybe they're in their own niche that Google and Meta are going to leave them alone. But I do know that they are in competition with Google right now that also advertises on gaming platforms, on games, I should say. Okay, I'm not going to talk much about the financial statements. They just kind of reiterate what we've seen already. I mean, one thing that's sort of interesting is the balance sheet. They've added 600 million in debt over the last year. It's a very manageable debt load for them, but I'm surprised they're still taking on debt. And if you look at, they're still doing buybacks, so this is effectively a leveraged buyback. And I don't know if that makes sense at these prices, because I think that we're at the point now where, a lot of future growth is priced in. And I would think if it was me, tactically, I would wait for, a better spot. Wait till the stock's out of favor. They were buying back a year ago quite a bit, which made a lot of sense. And maybe they know the future better than I do, actually guaranteed that they know the future better than I do. And maybe they can see huge earnings coming in 2025, which makes the company still cheap. But if I just do a little quick valuation here, let's say they got to, this is not a real valuation. It's just a sort of a ballpark. Does the current price make sense? So if they got they added another 1.8 billion in revenue next year, which I think is doable. Put them at 6.5 billion in revenue. That would be an increase in profit of, let's say, around 1.4 billion. If you use the 7-8% margin on that. Now I'm not going to adjust it. That's EBITDA, but let's just use that for now because I know that number. That would put them at about 3 billion in net income in 2025. Right, and so you can do your own valuation based on the market cap. I don't actually know what it is after this last spike. It's up by a quarter. So before it was 127. I don't know. I can't do the math. It's maybe like 160 billion. So if you're looking at 160 billion, and let's see, 160. I hope that's right. And use 3 billion as the income for the year, that's a 53 times multiple. Now it might be wrong. Maybe they've already updated it on TradingView, and maybe the current market cap is 127 billion. So it's either 127 or it's 160 kind of things. So either of those cases, you're looking at 40 to 55 future forward PE ratio, which is it's pretty high, right? So you'll have to do your own analysis, and it's very, for me, it's very hard to value fast growth businesses But a rule of thumb is you can use the growth rate as your PE ratio as sort of a fair price, right? So if you have a 50% growth rate, the PE might be 50, right? Like I wouldn't use that as my guaranteed number, but it gives you at least a little bit of a ballpark, right? So if they're going to continue to grow at these high rates, 40, 50%, maybe it makes sense, but at some point it's going to get harder. And I don't know where that point is. So I'm reticent to, I wouldn't add here, but I'm at the point where I'm leaving my position because I've taken 65% of the original position off and I'm just leaving this last bit. So at the last thing I want to talk about is their shareholder letter here and some of the points that they've made. So they say that their core beliefs are product first and flexibility over rigidity, automate before hiring, and ensure customers make money. And these are very good principles, right? Basically, they are saying, with a few of them, they're saying the customer is king, right? We want to make sure the customer gets the best experience and makes money, right? Product first, that's customer centric, right? Or that's business centric, long-term business thinking, right? You want the best product. You don't just want to sell what you've got. If you have junk and you have really good salespeople, eventually that falls apart. So if you continue to improve your product and improve the customer's ROI, like it's very hard to compete against a company like that. So as core drivers, and they've shown that these are their principles because that's what they're doing right now. And that's why they are potentially going to be the winner take all here in the space. Potentially. I'm not saying they are, could be. So flexibility, that's really important. This type of space changes so fast. If you can't change on the fly, you're going to get stomped at some point. So very important. And automate before hiring. This is really interesting. They're actually cutting headcount as they're growing like this. Find me a tech company that's doing that has ever done that. Like that is crazy. That shows me that these guys they're like machines, right? These principles are almost perfect, right? That's what you want as a business owner. You want management that's not just throwing cash around because they're making so much cash. So really impressive list here, and I believe them that these are the driving forces. This year, we'll go to the growth initiatives for the year. So our key initiatives. To advance our models, right? They're saying they're in the early stages, which is really amazing. Maybe that's just CEO speak and doing a sales job, but if that's anywhere near true, there's a lot of room here to grow. And like I said, the revenue almost all turns into profit. So, call me in 5 years and see how we're doing with this thing. So personalized ad experiences, that is really interesting. Like you do get stock, if you play games like mobile games, you get pretty stock ads, right? But they're going to leverage AI to make it more personal, use the data from the customer and tailor that to the customer, which is really crazy. And I'm a little worried about that because I have noticed on certain platforms that the advertising is getting better and I'm buying more things online. So I think that would be a game breaker if they were able to do that. Automating our dashboard, that's basically just customer focus. The customer is they're trying to make the customer more money. The AI agents would say, we recommend this and do this and do this to maximize your ROI. What customer is not going to like that? Help. Especially if it works, right? And if it works, boom, 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 boom. They just spend more. Expanding advertiser reach. The expanding advertiser reach. So that's like last time they're talking about e-commerce. They're actually companies selling things through their platform as opposed to just other games advertising for their own, trying to take eyeballs away from the game they're playing, right? So there's a little bit of a conflict of interest, right? If they can actually nail that e-commerce stuff, like again, that's probably a huge growth avenue. And then connected TV, I don't really know what they mean by this in terms of what they're doing there. So as I haven't listened to the call yet, but again, they're looking for more advertising avenues, which is good for us as owners. Anyway, that's my quick commentary on the company. I don't know. Looking at this market, it could just keep going up, right? Like the U.S. market is insanely priced right now. Everything is way overvalued, and they might be fairly valued. So they could theoretically double to get to an insane valuation. I don't know what's going to happen here. The market seems pretty exuberant, so we will see. But I will check you in the next video. Thanks if you made it this far, and this is not investing advice, not at all. Do your own research.